Most people don't realize that the decisions they make about money this year will echo through the next 4 years in ways they'll never see coming. A paycheck lands in the bank. A retirement account sits untouched. A question about tax strategy gets pushed to next April. And somewhere in that delay, thousands of dollars of potential savings just walk out the door. This is what happens when the system stays invisible. But something changed recently that creates a real planning window. A new tax law has shifted the landscape for retirees and near retirees in a way that actually matters. Not in a this will change your life overnight way. In a quiet, compounding way where timing becomes everything. Here's what you'll understand by the end. Why the next 4 years might be your best chance to restructure how taxes work in your favor. What specific provisions are available right now, and how normal people can use this window without needing a team of accountants. The foundation here is that most people know very little about how tax law actually works for them personally. They file every April, they get a refund, or owe money. Then they forget about it for 11 months. What they don't see is that tax planning isn't something that happens once a year. It's something that happens across years. It's cumulative, it's structural. And right now, there's a 4-year opening where the structure is actually more favorable than it's been in a while. Most people miss this, here's why. The tax code doesn't operate in single years. It operates in decades. Changes that were made about a decade ago to lower tax brackets and increase standard deductions were only supposed to be temporary. They had an expiration date. That deadline was approaching. There was real uncertainty about what would happen next. Then recently, a new law removed that uncertainty. Those lower brackets are now permanent. The standard deduction will keep increasing automatically. But the law also added something new, something temporary. An additional deduction specifically for people over 65. This is the part people overlook. It's not just that tax rules stayed the same. It's that new provisions were added on top, but only for a limited time. And that time window ends in 2028. That creates a planning opportunity that doesn't exist every year. Let's look at what actually changed in the numbers, because the story lives there. Starting in 2025, the standard deduction is increasing. For a married couple filing jointly, it's going up by $1,500. For a single filer, by $750. That's the baseline increase. So a married couple now has a standard deduction of $31,500. A single person has $15. $750. That amount of income you earn is automatically excluded from taxation. It's a tax-free zone. Think of it as the IRS saying, up to this amount you don't owe us anything. Everything above that becomes taxable income. This is before any other deductions. It's the foundation. But here's where it gets real. On top of that standard deduction, there's now an additional deduction for people over 65. It's $6,000 per person per year. That means a married couple where both people are over 65 gets an extra $12,000 on top of the base standard deduction. That stacks for that couple. The effective standard deduction in 2025 becomes $46,700. That's $31,500 base, plus $3,200 for the age-related increase that already existed, plus $12,000 from the new senior bonus deduction. $46,700 in tax-free income times some average tax rate equals meaningful deferral of taxable dollars. Most people don't do the math here. They see standard deduction and move on. But the implication is significant. For every dollar below that $46,700 threshold, zero tax is owed. For a couple living on $60,000 a year, only $13,300 of it is actually taxable. That's not a small thing. Now, here's where it gets expensive. That new $6,000 deduction per person doesn't apply to everyone. It phases out. And this is the mechanism nobody talks about, which is exactly where the real decision-making happens. The phase-out starts at $75,000 of income for a single person. For a married couple, it starts at $150,000. But here's the part that matters. It doesn't just disappear gradually. It disappears completely once you hit $85,000 for a single person, or $170,000 for a married couple. So there's a $10,000 window where the deduction phases out. Miss it by a little, and you lose it entirely. This is the part nobody notices. There's a cliff. Not a gentle slope, a cliff. If you're a married couple at $149,999 of income, you get the full $12,000 bonus deduction. At $170,001, you get zero. That $10,000 gap changes your entire tax calculation. Now here's the tension. This applies only through 2028. After that year, the senior bonus deduction disappears. The baseline increase to standard deduction stays, but the bonus portion goes away. So 2025, 2026, 2027, 2028. 4 years. That's your window. This is where normal people should start asking, what do I do about this? The answer depends on what your life looks like. But there are patterns. The first pattern is Roth conversions. This is where it gets interesting because most people have heard the term but don't really understand the mechanism. A Roth conversion is moving money from a pre-tax retirement account, like a traditional IRA or 401k, into a Roth IRA. You have to pay income tax on whatever you convert in that year. You do this intentionally. Why would you do that? Because once the money is in a Roth, it grows tax-free forever. And when you withdraw it in retirement, zero tax. But the reason to do it right now specifically is because you can do it while your taxable income is lower. Think about the math. You have a $46,700 standard deduction. If your income is $50,000, only $3,300 is taxable. You're in a low tax bracket. If you then convert $30,000 from a traditional IRA to a Roth, your taxable income jumps to $33,300. Still pretty low, but in 3 years, that $30,000 conversion amount becomes irrelevant because the deduction rules change. 30,000 conversion times 22% tax bracket equals $6,600 in tax paid now versus potentially 32% or higher bracket in future retirement distributions equals tax savings over decade. The second pattern is capital gains harvesting. This is simpler than it sounds. If you have investments in a taxable brokerage account that have gone up in value, you have a capital gain, you owe tax on that gain. When you sell, capital gains have their own tax rates, and they're usually lower than ordinary income tax rates. But the key is you can only use a certain amount before they bump into higher brackets. With your enhanced standard deduction and low taxable income in 2025, you have room to realize capital gains in a lower bracket. You can sell something that's gone up, pay tax on the gain, and then immediately repurchase it. You've locked in a lower tax basis for future growth. In 2029, when the rules change, you don't have that flexibility anymore, and those capital gains become part of a higher income picture. This is where it gets real because most people don't think about tax planning as something you do with intentionality. They think you file taxes because you have to. But sophisticated people understand that you structure income and gains to fall into the brackets where you have room. The third pattern is IRA withdrawal timing. Most people with retirement accounts have to start taking required distributions at 73. But if you're between 65 and 73, you have discretion. The traditional move is to take as little as possible because every dollar you withdraw gets added to your taxable income. But in these 4 years, with the enhanced standard deduction, you have room to pull money out at a much lower tax cost. Think about it differently. Imagine you're 66, retired, and you have $800,000 in a traditional IRA. You're not required to withdraw yet. You could live on Social Security and other money. But what you're not seeing is the trap waiting. When you eventually do have to take required distributions, combined with Social Security, your taxable income will be substantial. All of that gets taxed at higher rates. You have no flexibility, but if you're willing to pull $50,000 from that IRA this year, while your other income is low, you pay tax on it at a lower rate. In year 2, you do it again. By the time you hit 73 and required distributions kick in, you've reduced the account. Your required distributions are smaller. Your future taxable income is lower. The math compounds differently. Most people miss this. Here's why. The paperwork feels complicated. The timeline feels abstract. It feels like something you should do someday. But here's the system: reality. Tax brackets are fixed in time. Deductions are fixed in time. Your income is fixed at specific moments. Those 3 things either align or they don't. Right now, they align in a way that's favorable. In 2029, they won't. That's not a threat. It's a fact. It's the system. Now, some people read this and ask, doesn't this affect everyone? The answer is no. The phase-out thresholds matter. If you're a married couple living on $200,000 a year, this doesn't apply to you the same way. Your income is too high to use the full bonus deduction. You lose access to it entirely. So the planning window is most relevant for people in a specific income band, above $150,000 for couples. And you're phased out below that, and you have options. This is where another hidden rule appears. The tax system is designed with brackets and phase-out specifically so that the benefit concentrates in a band. If you're above the band, these provisions don't help. If you're below the band and your income is very low, the benefit is smaller because you don't have enough taxable income to benefit from the deduction anyway. The real opportunity lives in the middle, and that's where most working people are. Here's what usually trips people up. The assumption is that you need a lot of money to benefit. You don't. You need intentional planning. A couple with $120,000 a year of income can benefit tremendously from this window. A couple with $60,000 can benefit differently but meaningfully. A couple with $200,000 can't use the senior bonus deduction at all, but they can still use Roth conversions and capital gains harvesting within their constraint. The system doesn't care about your status, it cares about numbers and timing. Here's the part where doubt creeps in. This sounds legal, but is it? The answer is yes. These are provisions in the actual tax code. A qualified tax professional can confirm that these strategies are standard practice. But here's the reality. Nobody mentions doing this requires paperwork. It requires documentation. It requires making decisions before year end, instead of in April. Most people don't do it because the default is easier. The default is to file when you're required to and collect your refund. But the default is also where thousands of dollars get left on the table every year. This is the last piece. Understanding the system is one thing. Using it is another. Using it well requires coordination. A Roth conversion affects your Medicare premiums if you're over 65. A capital gain harvest might affect your tax rate that year. An early IRA withdrawal requires thinking about when you need the money. These pieces interact. They're not independent decisions. That's why so many people think they need professional help. And sometimes they do. But what they really need is clarity. They need to understand what's available, what the constraints are, and what the timeline is. Then they can decide. Here's what happens if you do nothing. The 4 years pass in 2029. The senior bonus deduction disappears. Your standard deduction is lower. Your available planning room shrinks. Someone who was in your exact situation could have moved $100,000 to a Roth at lower tax costs. Now that person has a tax-free growth account for 30 years. You don't. The difference compounds. 100,000 growing at 6% annually over 30 years equals 574,000. With tax-free withdrawal. That's not theory, that's math. Most people experience money anxiety because they feel like they're missing something. This feeling is usually accurate. They are missing something. It's not always big. Sometimes it's a rule they didn't know about. Sometimes it's a deadline they didn't see. Sometimes it's coordination they didn't think to do. Right now, if you're a retiree or near retiree, you're missing a 4-year window that's not an opinion. That's what the law says. The clean way to think about this is that you have choice now, not in 2029. Now you can structure your income and withdrawals and investments during these 4 years in a way that lowers your lifetime tax bill. Or you can do nothing and pay more taxes across your entire retirement. Neither choice is wrong, but only one of them is intentional. Here's the practical step most people skip. List your sources of income, your Social Security amount, your retirement account balances, your investment accounts, your age, your spouse's age, if you're married, your other income. Write it down. Then ask one question. Given these 4 years of favorable deduction rules, how much can I move or convert or harvest without going into a higher bracket? The answer to that question is where the real planning lives. The system doesn't make this easy because the system benefits when people don't optimize. But it's not complicated once you see it, and you're seeing it now. 3 core ideas to hold the senior bonus deduction is only available through 2028. Creating genuine urgency. Your income thresholds determine what you can access. So know your numbers, and timing matters more than total amount. Because 4 years of strategic decisions compound differently than one panic decision in year 5. If you want to understand this deeper, there are resources available that walk through the actual calculations, but the foundation is this. You have a window. The window closes in 4 years. What you do now ripples through a decade of tax bills. That's not marketing. That's how compounding systems work.